Welcome, everybody. Thanks for joining today's webinar. I'm your host, Jason Natick. If you started trading options, then chances are you've noticed some Greek words listed on the option chain. Terms like delta, gamma, and theta, followed by a bunch of numbers you may or may not understand. Well, don't worry if you're a little bit curious and feeling a little bit intimidated both at the same time. After all, the last time you saw Greeks may have been way back in high school calculus class. The values that we're going to be discussing today are termed the option Greeks, and they measure important factors that experienced traders often consider when managing their positions. Yes, the Greeks may seem complicated to wrap your head around at first, but they may help you to minimize trading risk and potentially maximize your trades if used correctly. So let's translate some common option Greeks into everyday English. Here to help us is Nitesh Bansal. He's the director of academics at Futures First Academy. He'll explain what delta, gamma, and theta each measure and how to use them and to inform yourself in your next trade. Nitesh, thanks so much for being here with us. Now, before we jump into a discussion about option Greeks, I have a trivia question for the audience. How many option Greeks are there in total? So stick around until the end of our conversation and we'll reveal the answer. Okay, it's no secret that option Greeks can be intimidating to novice traders. So let's start with the basics. What do option Greeks measure and how can they be useful to options traders?
Okay, so option Greeks refer to sensitivity of options price to each variable. Before we understand this exact definition, we need to understand how options are priced. Options are dependent on 5 base variables, and these variables are the price of the underlying stock, the volatility of the underlying stock, the option's strike price, the option's time to expiration, and interest rates. So if you see the price of an option changing, it is definitely happening because of the change in any of these variables or all of them at the same time. When we are referring to Greeks, we are trying to figure out what happens to the option price when we change one of these 5 base variables. Of course, in reality, it doesn't happen like that. All 5 base variables change together, but this way, measuring the impact of each variable on options price helps us isolate that impact and helps us understand and interpret the Greeks. Eventually, once we have a good understanding of Greeks, they will not help us price an option directly, but they will help us understand how an option price changes in response to changes in any of these 5 base variables. Greeks could help traders understand such sensitivity and changes in that sensitivity. They could also help you decide which option to buy, which option to sell. They could also help you time your entry, time your exit, and eventually they are very helpful in limiting potential risks.
So the Greeks can help us manage our option trades. Of course, they can't tell us everything we want to know. What are some of the limitations of Greeks that option traders should consider?
Of course. So there are 3 limitations that we need to be worried about when we're looking at Greeks. The first one is that out of the 5 base variables that we talked about, there are some variables which influence an option's price, but are really difficult to understand, interpret, and analyze. At the same time, there are some variables which are very easy to understand, very easy to interpret, and very easy to manage. For example, time to expiration is a variable which is relatively easiest because its value changes in a very predictable and objective way. However, at the same time, changes in the underlying stock's price is very difficult to understand and interpret because at the same time, many factors impact it. The second limitation we'll talk about is understanding the usefulness of Greeks. Remember, like we talked about the controlled experiment just now, you can think of Greeks as a machine, and the output of the machine is only going to be as good as the inputs. So for example, if your expectations of how the base variables will change are flawed or are limited or are wrong, then the output, that is, by how much the options prices will change, will also be wrong. So usefulness of Greeks is only as good as your expectations of how the base variables will change. Greeks do not tell you how the base variables will change. They will simply help you understand if the base variables change, what happens to the options price. They don't help you predict future at all. If your assumptions are mistaken, then your estimates will be wrong, and the decisions that you take on the basis of such estimation and such analysis will also be wrong. The third limitation of Greeks is that they are essentially still guideposts. They might be a good machine, but they are still guideposts. And that is because when they are indicating a certain number that options price will change by this much percentage, that is not a guarantee. It is very much possible that the option price changes, the actual changes are a little bit here and there. And that's purely because there are many second and third order Greeks as well, which cause a change in the option price, which are which are not very easy to understand and manage.
All right, so option Greeks can be one tool to help traders limit their risk. And if you're interested in hearing more about some of the other approaches, tune into our webinar titled How I Minimize Risk as an Option Trader with another one of our guests, Cody Ye. Now that we've established some groundwork, let's unpack some of the common option Greeks, starting with delta. Nitesh, what does delta measure?
We talked about the 5 base variables, and one of those base variable was the underlying stock price. And we discussed that all the Greeks are measuring sensitivity of options price to the change in one of the base variables. Delta measures sensitivity of options price to the changes in the underlying stock price. It ranges from 0 to 1 for call options and from 0 to -1 for put option. For example, if you have a delta of zero point 0.7, that means a $1 change in the underlying stock price will cause a $0.7 change in the options price, which basically means that you would capture most of the value in the underlying price change. Similarly, at the same time, if you have a delta of zero point 0.2, that would mean a $1 change in the underlying stock price would cause a $0.2 change in the options price. And that basically means that you would not be able to capture most of the value in the price action of the underlying stock. As the graph in front of you suggests, delta tends to be higher for deep out of money puts and for deep in the money calls. And the reason is because when the prices are rising, when the underlying stock price is rising, any movement in stock has a significant impact on how likely it is that the strike price is reached before expiration of the option. So if you look at the graph of the delta, it moves from left to right, but in a rising fashion. So for call option, it moves from 0 to 1. So it is rising from 0 to minus 0 to 1. And for put option, it is moving from -1 to 0. In both cases, it is rising.
Okay, so how might traders use delta to help them decide when to buy or sell an option?
Traders typically want to align delta with their expectations of the underlying stock's movement. For example, if you have high confidence in stock's price rising, there is no point buying a call option with low delta. If you expect the market to rise, if you expect the underlying stock to rise, of course you're going to buy the call option. But different strike prices will have different delta. There is no point buying a call option with low delta. When we say low delta, we're talking about something as low as zero point 0.1 or 0.05, something very close to zero. Because you would be paying premium for an option that is not going to see its value rise much when the stock price rises. You would not gain much from being correct about the underlying stock's price movement. Therefore, it makes sense to buy, in this case, a call option with relatively high delta. Here, by high delta, we do not mean a delta of zero point 0.9 or very close to 1. High delta simply means something in the range of 0.4 to zero point 0.6, which basically means a call option which is just slightly out of money to very slightly in the money. And the reason is that if you are very near to this number, then when the stock price rises, you're able to capture most of the movement in the underlying stock in terms of movement in the options value. If you think that you have 60%, 70% confidence based on whatever strategy you're following that the prices perhaps will move up, then that 60%, 70% confidence needs to be aligned with a delta value of 0.4 to zero point 0.6. Do not align the confidence level of 60 to 70% with a delta of as low as zero point 0.1, because if you're right, you're not going to see the options price rise that much because you've bought an option with very low delta.
Okay, so you've given us a couple great examples of things to look for. Can you give us maybe some situations that traders need to be careful about with how they manage delta in their positions?
Sure. The first very important point is that we should not ignore delta. And the reason is because if you ignore delta, then you're ignoring the fact that the probability of you losing more money and the speed with which you would lose such money is going to be very high at high delta. This can be problematic during episodes of very high volatility, the way we have seen volatility jumping up this year in the first half, because during episodes of high volatility, underlying price swings sharply. And when the prices are moving sharply, then the chances of delta also moving and affecting the options price increases. The second point is that we should be aware of known events. For example, earnings release is an event which is pre-announced and we all know about it when the earnings for a company will be announced. And the reason is because if we know about known events, then we are certain that around such events, the chances of market picking up volatility are higher. And that basically means that it could cause a high delta option to move very sharply, which basically means that the possibility of a high movement is known to us in advance. If you're not comfortable with volatility around such known events, then it's best simply not to trade. The flip side of this is that a lot of times we are aware of known events, but we simply ignore the possibility that there could also be a lot of unknown unknowns, which means unexpected events that could make delta even more relevant. Remember, when such an unknown event occurs, it's a surprise for everyone, not just for you. And because it's a surprise for everyone, it may drastically affect the way everyone is trading in the market. This may create a feedback loop of even greater volatility because when the actual event occurs, it's a surprise for everyone. And then in panic, a lot of people trade and behave irrationally. And that loop simply goes on and on, which means volatility is feeding volatility. This causes very unpredictable movements in option, and it may simply turn your assumptions upside down. But if you're aware of unknown unknowns, you know the possibility of delta impacting your positions significantly, and it will help you to place risk mitigation bets. For example, you could hedge your positions or place the right stops. At the end, I would also like to mention that it is also very common for novice traders to not have an exit strategy at all. If you have an option with a delta of zero point 0.7 and you're trading such an option right before the earnings release, then remember the high delta could also make the market move against you very quickly. If you have a stop loss to avoid staying in that option position, then it helps you lose less money. Because when the market moves very sharply, it will not give you enough time, ample time to manage your position at that time.
Yeah, that last point you're making about exit strategy, that's one thing that's maybe often overlooked, but is can be very important, and especially in volatile
Dollar.
times like we're living right now, it is a key part of a good trading plan. Okay, so we've unpacked delta. Let's move on to our next Greek, gamma. What does gamma measure?
Gamma is something which is known as a second order option derivative. And the reason is because it is not directly checking the sensitivity of options price relative to another base variable. It is actually very interestingly measuring the sensitivity of options delta relative to what is happening to the underlying stock. In other words, it measures how quickly the delta is moving for a given change in the underlying stock. Remember that gamma does not have a linear relationship with delta, but rather a parabolic one. If you look at the graph of delta, delta is not moving linearly up. For example, for a call option from 0 to 1, it is not a line. It is moving like a curve, and that curve is also changing at different points. That change is known as gamma. And if you plot the changes in delta, which we know as gamma, it is going to look like a bell-shaped curve on a graph like this one, rather than a straight line. As you can notice in this graph, gamma tends to peak when the option is at the money, which basically means when the underlying stock is moving away from the strike price of your option, then the gamma starts decreasing. Notice two important things. I mentioned that the underlying stock's price moves away from the strike price. I did not say it moves up or down. And the reason is because the gamma curve is symmetric on both sides of the strike, which basically means irrespective of whether market goes up or down from the strike price of the option, the gamma will definitely decrease. Another important point is unlike delta, gamma is always positive for both call options and put options. Let's take an example to understand gamma. If a call option has a delta of zero point 0.5 and a gamma of zero point 0.1, that basically means that a one change in the underlying price would cause the option price to move by 50 cents, and delta itself will change from zero point 0.5 to zero point 0.6. How did we arrive at this 0.6? When you're looking at both delta and gamma, simply add the value of gamma to delta. In our example, we had delta equal to 0.5 and gamma equal to 0.1. We simply add them and we got 0.6. That simply means if you add gamma to delta, you will be able to figure out the new delta after a 1 unit move in underlying.
Okay, so how can gamma help an option buyer figure out how risky an option position may or may not be?
The gamma graph will help you assess how much delta will change as the underlying stock's price is changing. Irrespective of whether you're buying the call option or the put option, if the market moves in your favor, then because you're long gamma, the gamma will help you make more money faster. You will be able to reach your goal faster. And the moment you move beyond peak gamma, that is if the option is no more at the money, that is if the price moves away from the strike price of the option, you would still make money, but the gains in the value would start getting reduced.
What about on the other side of the trade? For option sellers, how can gamma be useful?
Gamma is very important for sellers as well because a large move in the underlying can also greatly impact whether the option is expiring worthless or not. The shape of the graph for option seller is exactly the same as for the option buyer, but upside down, which means that just like an option buyer is concerned whether the given option is at the money or not, the option seller also needs to be concerned whether the given option is at the money or not. Remember, gamma is most impactful when there are large movements in underlying purely because it's the second order derivative. So if you're aware of gamma, it is helpful no matter what your expectations for underlying are because your assumptions could turn out to be incorrect. So if you sell an option when it is at the money, at that time you're causing maximum change in delta, which means if the market goes against you, in this case, if the market goes above, if this underlying stocks starts rising, then your losses would come to you very, very fast. Which basically means, to summarize, for an option seller, it is very important not to sell an option at the money because at that point the gamma is the highest and it causes maximum negative impact to an option seller's position.
All right, so let's move on to the last Greek that we're going to touch on here in our time, and that'll be theta. What does theta measure, Nitesh?
So theta measures the rate of change in an option's value as it moves towards its expiration date. Remember, I indicated earlier that time to expiration is a very important but very easy variable to understand because we all know how time moves. Every single day, the expiration of the option is reducing by 1 day, exactly by 1 day. And all of us know about that. This is often referred to as time decay because options value is decreasing as time passes because there is more certainty of the option expiring worthless. Let's take an example. If you buy a call option with theta being equal to zero point 0.2, remember theta is measured in cents. So a theta of zero point 0.2 would mean that the option will reduce in value by 20 cents every day. But if you sold this call option, then the opposite is true. If you sold this call option, then you are gaining 20 cents every day because the time to expiration is reducing by 1 day every day.
Okay. Okay, so now we understand what theta is representing. How can a trader use that to squeeze the most out of their trade?
Theta can suggest when an option's time value will start to fall sharply, and therefore it is very helpful to figure out an optimal time to exit. The optimal time tends to be about 1 month before the expiration. But if you zoom in really in that graph, you would also see that if it's only last 1 month remaining for the option to expire, then within that 1 month also, the last week is very important. For example, for an option, it is important to realize that option will quickly lose its value when it nears its expiry. This is particularly helpful to the option seller, but at the same time, very problematic for an option buyer. If an option buyer, for example, is less confident of making money, for example, let's say if you buy a call option today and you think the market will go up and the option has exactly 30 days to expire. As days pass by, you are less and less confident about what will happen to your position, whether the market will move in your favor or not. As you move towards that 1 month before expiry threshold, it is better to close your position before the exponential drop in option value happens. Similarly, for an option seller, the option generates most of its profit near the expiry. And all of that happens in an exponential manner. For example, if you've sold the call option and you are near that 1 month time threshold, then you have to remember as an option seller, most of the money is going to come to you now. For both option buyers as well as sellers, Theta is very helpful. For an option seller, we call it as a friend. For an option buyer, we need to understand that Theta is not really an enemy, but you need to be very, very careful about it because it is one of those factors wherein you could still lose money despite being right.
Okay, so we're going to have to halt our conversation there. I really do appreciate you making sense of delta, gamma, and theta for us, Nitesh. Now, you can find all three of these Greeks when researching options in WebBroker. We're going to take a few minutes to actually show you how. To find the option Greeks information on the option chain, we need to select the plus symbol next to analytics located just above the option expiration dates. Now, because for this example I've chosen an ETF that has a very large number of strike prices, to make it more manageable, I'm going to have WebBroker filter to display only those strike prices listed as near the money. Once updated, we can scroll down and we will see that the call options are now going to be listed above, with the put options now listed below, and the strike prices are now going to be on the left-hand side of our screen. For this particular example, we're going to be focusing on the $416 strike price. Moving towards the middle of the option chain, under the delta column, we see a value listed as 0.511. What that is telling us is that with a $1 increase in the underlying stock, we expect the option premium to increase by delta, or 51.1 cents. Now, moving one column to the right, we see gamma. Gamma is listed at 0.019 for the $416 strike price. Gamma is telling us the rate of change of delta if the underlying asset goes up by $1. So the new delta can be ascertained by adding the gamma of 0.019 to the current delta of 0.511, giving us a new delta of 0.53. Now, moving one column to the right, this brings us to the last Greek that we learned about today. That is theta. And you see a negative number of 0.175. Theta is commonly referred to as time decay. Theta is telling us that with the passage of 1 day's worth of time, we can expect to see a decrease in our option premium of 0.175 or 17.5 cents. Now, please keep in mind that time decay is not constant through the life of your option. The time decay will actually increase exponentially as your option approaches its expiration date. Okay, so now that we know how to find the theoretical Greek information on the option chain, I'd like to show you a pretty interesting tool that WebBroker has to offer to help you practically apply some of that newfound knowledge. Located above the option chain, you'll notice there are 4 editable fields. We see volatility, stock price, days to expiration, as well as interest rates. For our example, we're going to be focusing on stock price and days to expiration as they align closely with the 3 Greeks that we've spent time discussing. Now, this tool allows you to put in expected market changes and have WebBroker calculate what the approximated theoretical value of your option premium would be. So let's say for this example, we expect our our underlying asset to increase to $420. And let's just say we expect that to take 1 week to happen. So we'll deduct the 7 days from our days to expiration, leaving us with 21. We'll have WebBroker calculate that, and once complete, we'll look down and refer back to the $416 strike. So it's still presently bidding 945 by 949. But if we move over to the right under the theoretical value column, with the expected changes that we've implemented onto the system, the new value can be expected for our option to be quoted at $10.10. So it's a pretty useful tool to help out you game entry and exit signals, put in market fluctuations so that you can help be a more informed trader. Thanks again for tuning in, everyone. We're now going to head over to our live Q&A in just a quick moment. But first, let's reveal the answer to our trivia question. As a refresher, the question was, how many option Greeks are there in total? The answer may surprise someone. The answer is actually there are 16 total option Greeks. All right, I'll run through them. The first order Greeks are delta, vega, theta, rho, lambda, and epsilon. They measure the impact of various factors on the price of an option. The second order Greeks are gamma, which we've discussed, vana, charm, valma, veda, and vera. These measure sensitivity of the first order Greeks to small changes in other various factors. And then we have third order Greeks. Their speed, zoma, color, and ultima. They measure the sensitivity of the second order Greeks to small changes in yet other factors. However, most option traders focus on the three option Greeks that we've touched on in this webinar, delta, gamma, and theta. Okay, Nitesh, let's move on to our live Q&A.